Hello and welcome to the ADM Investor Services Weekly Market Kickoff. Please note that the views and opinions expressed here today are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or Archer Daniels Midland. Today's guests are the ADMIS Research Team of Mark Bowman, Mark Soderberg, and JP Steiner. Starting with the grains, Mark Soderberg, how will the recently announced U.S.-China trade deal impact the global soybean trade?
Thanks, Jeannie. On the surface, I think it essentially takes global soybean trade back to where things were before this most recent U.S.-China trade dispute. But in reality, we really just don't know how things will shake out with still so much uncertainty. While the Trump administration, they maintain that China has agreed to buy 12 million metric tons, or about 440 million bushels of U.S. soybeans for the 25-26 marketing year and 25 million metric tons for each of the next 3 marketing years. So far, we've heard nothing concrete from the Chinese side. There have been indications China has booked somewhere between 15 and 20 million bushels of U.S. soybeans for late December or January shipment. However, if they are to reach this 12 million metric ton figure by the end of January, they're going to need to buy 33 million bushels of soybeans each and every week. By February, China is widely expected to flip their purchases back to South American origin, notably Brazil, as their offers are nearly a full dollar per bushel discount to U.S. soybeans. And since this announcement last week, U.S. prices have rebounded to levels very competitive with Chinese offers. And as a result, we've already seen this has already prompted China to go buy another 10 cargoes of Brazilian soybeans for December shipment and another 10 for shipment next spring. So we're already seeing some evidence that the recent surge in U.S. prices is cutting into potential demand to the world's second largest economy and the largest soybean importer. You got to remember that this trade agreement with China is likely non-binding, so China will not be inclined just to buy U.S. soybeans or any other commodity for that matter, irregardless of price. China is still going to buy what China needs, and they're only going to buy it from the lowest price providing country. While it's definitely a step in the right direction, I think some sales are better than no sales. And I think it's going to be a stretch to think that we're going to sell over 400 million bushels of beans to China for this 25-26 marketing year, unless U.S. prices slip back below what's being offered in Brazil.
All right. What are your expectations for U.S. corn and soybean production and stocks ahead of the USDA report now scheduled for the 14th?
Yeah, I've got U.S. soybean production at 4.240 billion bushels. That's down 61 million bushels from the USDA forecast in September. I've got the average yield slipping to 52.8 bushels an acre. That's still a record high, but below the USDA forecast at 53.5. Given all the uncertainty here on the demand side, particularly with China, I think the USDA is going to take a measured approach to their export forecast. I've got them down 100 million bushels to 1.585 billion bushels. As a result, my ending stocks forecast for 25-26 is at 323 million. That's up from the USDA estimate in September at 300 million, but very little change from the 330 from last year. In corn, I've got production at 16.435 billion. That's down 379 million from the USDA estimate 2 months ago. My average yield at 182.5, still a record, however, below the USDA's at 186.7. On the demand side of the equation, I see both exports and usage for ethanol production holding up quite well. Feed usage from the USDA is probably too high. I'm down 200 million bushels from the USDA estimate. I'm at 5.9 billion. So with the lower production combined with lower usage, my ending stocks figure is very little change. I'm just over 2.11 billion bushels, very little change from USDA in September.
All right, thanks. Now moving over to Mark Bowman. Mark, what is in store for the cocoa market this week?
Well, okay, so we've seen some revisions lower recently for the 2025-26 main crop production for West Africa. as we had this dry spell in August that overstayed its welcome, and it slowed pod development for the main crop, which officially began October 1st. When the rains finally started to arrive in mid to late September, production expectations rose. Farmers in Ivory Coast and Ghana were just turning more optimistic in their weekly updates about the upcoming crop. They were citing adequate rains for good pod growth, and not too much rain either, thus avoiding disease problems like black pod and swollen shoot. Now, the gauge we have on output, one of them is Ivory Coast port arrivals, and they have started out slow. These are weekly arrivals numbers, estimates really. And as of this past Sunday, cumulative arrivals had reached 304,000 metric tons, which is down from 365,000 last year at this time and below a 5-year average of 363,600. But they did improve this past week. Ivory's arrivals this past week, 90,000 tons versus 82,000 the previous week and 80,000 a year ago. And this was the largest total for the 5th week of the season in at least 5 years. So perhaps we're at a crossroads here. Perhaps traders will start to change their views towards main crop, at least if they start seeing arrivals increase in Ivory Coast.
And what do you think will drive the energy markets this week?
So we had a monthly EI report on Friday that showed U.S. oil and gas production rising to record highs in August. This really should not be a surprise. Those looking at the weekly EI report showing U.S. production being, especially crude oil production reaching record levels, both on a per day basis for crude oil in August, and also natural gas production reaching record levels in August. Since then, they've fallen back a bit, though. Now, for example, go back to the crude oil, 13.8 million barrels per day in August versus previous record of 13.7 million in July. Strong output in New Mexico, the second largest state, a record 2.3 million. And the offshore Gulf region rose to 1.98 million barrels per day, which is the highest since February 2020. We're expecting more growth out of the Gulf. Now, the top onshore fields are starting to mature. Likewise, natural gas production for the lower 48, 122.8 billion cubic feet per day in August versus the previous record of 122.1 billion in July. But now, what does natural gas have going for it? We have kind of a trend towards lower production over the last couple of months and higher U.S. LNG exports. On Friday, LSEG reported the average amount of gas flowing to the 8 big U.S. LNG plants, 16.6 billion cubic feet per day in October. This is up from 15.7 in September, and it beat the previous record from April of 16 even. So we're now at new record levels on exports. Likewise, average gas output in the lower 48 after reaching that record 108.0 billion cubic feet per day in August fell to 107 billion in October. So we're off there. This does possibly project a tighter supply going forward. Now, crude oil a little different. We have increasing global supply. OPEC Plus is lifted around 2.8 million barrels per day of production restrictions this year. They announced another 137 barrel per day increase for production potential for December. But then they also said they'd hold flat for the first quarter of 2026. We have the sanctions on Russian crude, which, if they work this time around, will limit supply and possibly provide an offset for that higher U.S. and OPEC Plus output. China has been aggressively rebuilding stocks this year. The question is, will they continue? But the U.S. also needs to rebuild its SPR after drawing it down a couple of years ago.
All right, thanks, Mark. Finally, JP, how will this week's private U.S. data shape interest rate expectations?
Week is set for a release of ISM purchasing manager surveys and also the ADP private non-farm payroll figures, which will have to serve as replacements for a lack of official government data on the health of the U.S. economy given the shutdown. This morning, ISM's U.S. manufacturing purchasing managers index for October was released, and the results came in below expectations. The index fell to 48.7 from 49.1. In September, that was below expectations of a reading of 49.5, indicating an 8th consecutive month of contraction in the manufacturing sector. Production shrank, and further contractions were also seen in new orders, inventories, and backlog of orders as well. Notably, too, employment declined, with a 67% of panelists indicating that managing headcount is still the norm at their company as opposed to hiring. Meanwhile, and what's a positive sign for the Fed, price pressures eased. The manufacturing prices index hit its lowest level since January. The prices index has seen 4 consecutive months of declines, signaling that tariff-induced inflation could be subsiding, acting as a one-time pass-through on prices rather than a consistent pressure on prices. Although I should say this is survey data and not official government data, where we will see the actual effects. Elsewhere, the supplier deliveries index indicated slower delivery performance for the 3rd consecutive month as well. Of the 6 largest manufacturing industries, only 2, being food, beverage, and tobacco products, as well as the transportation equipment industry, expanded in October. Looking ahead, we will get ISM's PMI index for the services sector on Wednesday. That will likely garner more attention than the manufacturing survey, as the U.S. is a services-dominated economy. Additionally, special attention will be paid to the services prices index. Services inflation has been a cause of concern for some members of the FOMC, specifically Dallas Fed President Lori Logan. She recently said she finds it difficult to find a reason to cut rates in December, as she still remains worried about services prices. So the ISM data will help give us a picture on how private sector activity has been holding up in the face of the shutdown, and could provide some leading indicators on inflation. These inflationary signals are likely to get more attention than normal given the circumstances. However, I believe their impact on sentiment will be greater on markets than it will be for officials at the Fed. We'll also get ADP private non-farm payroll data on Wednesday. That's been serving as the main auxiliary figure for a look into the health of the labor market. Forecasts are expecting a reading of 28,000 new private payrolls. That would be a rebound from last month's net loss of 32,000 jobs. So in my opinion, I think that the data will certainly help shape market expectations of the Fed's trajectory for December, but it will be unlikely to move the needle much for those at the FOMC, especially members who have been remaining very hawkish about the inflation picture.
All right, last question, JP. What notable Forex events are happening this week?
Yeah, following last week's jam-packed slate of European data and the European Central Bank's rate decision, which saw the central bank there leave interest rates steady, we have a relatively quiet week of data for the Eurozone. Across the channel, though, the Bank of England will announce its interest rate decision on Thursday. The bank is widely expected to hold rates steady at 4% as the country prepares for the government's budget announcement late November. We have seen weaker inflation and jobs data out of the UK recently, but that's likely not going to be enough to get the Bank of England to lower rates, given that inflation still remains well above their target at 3.8%. Money markets are showing what's right now a 31% chance of a rate cut. Some investors have been speculating that given the weak jobs market, the bank should cut rates. However, those remain the small minority. The Bank of England will also release its quarterly monetary policy report, where it will show its forecast for inflation and economic growth. That will also help shape expectations about how the bank will move later on. The bank had previously forecasted inflation to peak in September and then begin to subside. However, September's inflation report showed that prices remained unchanged from August. As I said earlier, the annualized figure remaining at 3.8%. That came in below expectations of the bank's forecast of 4%. So I'll be curious to see how the Bank of England adjusts its forecasts. Lastly, on the foreign central bank front, the Reserve Bank of Australia, they're set to meet on Tuesday or late night tonight for the U.S. It's also expected to leave rates unchanged, their benchmark rate being at 3.6%. This is coming after an unexpected pickup in third quarter inflation. Governor Michelle Bullock there signaled that the labor market is in a solid place. core inflation rests on top of the RBA's target band, and trimmed mean CPI, which is a key measure of inflation for those there, rose 1% in the third quarter. That was above expectations of a 0.8% rise, making it unlikely that the bank could deliver a rate cut before year end. Recent data also showed that home prices surged 1.1% in October. That was the biggest jump in more than 2 years. Rate cuts have fueled demand for houses there. We'll also see the Bank of Japan release its meeting minutes from its September meeting, where 2 board members voted to hike rates to 0.75%. After the bank had held rates steady at its meeting last week. The Bank of Japan Governor Kazuo Ueda recently said he sees no risk of Japan falling behind on the monetary policy front, signaling that the central bank is in no rush to hike rates. Markets have been increasingly skeptical that the bank will not deliver a rate cut before year end. That's been partly pushing the yen lower among some fiscal worries there about the new government's fiscal expansionary efforts.
All right. Thank you all for your time this week. Remember, the views and opinions expressed today on this video are solely those of our guests and speakers and should not be construed as the views or opinions of ADM Investor Services or ADM. If you would like more information about our brokerage services, please visit admis.com. Thank you.